Okay, we're going to get started by looking at the S&P 500 like we usually do. You can see that we made a substantial recovery from the lows when tariffs were first announced. We actually have a situation in our in our 200-day and uh, moving average. We're at 42% above the 200-day moving average. We're gaining momentum. We have 60% above the 50-day moving average. So, all right. So we have a situation where we're above a 50-day moving average, and the 200-day moving average is right around the corner. If we could hold above this 200-day moving average, we're below it right now. This is like a resistance. So we're going to be hitting up against this range. Right now, we have right now we have a range between here, which is 4,800, and here, which is 5,900. So we have a range in the S&P between here and here. And right lately, it's been going up and down based on the news flow. But if we can stay above this moving average, if we get a good news story like a China deal, and we stay above this moving average, it looks like we're going to be hitting higher highs and higher lows. Otherwise, we're still stuck in this trading range. Let's look at the trend lines for the S&P. You can see we broke through this trend line right around the time that we mentioned 2 weeks ago that we had this breath thrust. We have, okay, so we have a situation where we're making a new up channel here, and we have, we're approaching the 200-day moving average. Let's hope it gets above the 200-day moving average and stays there above it. Otherwise, the 200-day moving average is resistance, like it was right here. All right, let's look at some of our talking points. Okay, so we're in May. May is traditionally a really good month for the stock market. You can see that it's up on average 1%. So June is a month where there's not a whole lot of earnings reports coming out, and a lot of people in the stock market take off June for a holiday. So so you have a lower volume during the summer times. July we have earnings again, so and we have a July 4th holiday. Uh, August, September have traditionally been very poor months in the stock market, and we usually have a year-end rally. So, keeping that in mind, let's look at some of our numbers. Okay, so we are overbought right now. The S&P actually closed down 0.5% last week. And let me see. Okay, our theme from the beginning of the year was revert to the mean, and we'll see how that's playing out. Healthcare, telecom, financials, energies, utilities did worse last year, and we're seeing that they do better this year. Um, One thing that's for certain this year is we're going to have uncertainty. It's certain to have uncertainty. The We're going to have daily announcements by the president, which move the market. It seems like there's a pattern developing of shock and awe. So we have this amazing statement that could rattle the business models of every business, and we have a sense where if it makes the stock market goes down, then Trump backs off the comments or says something like it's time to buy the stock market. So we do have a sense where well, Trump de-escalates an issue if it affects the market too much. Um, so it's going to be crazy to invest, but the important part is you can't take everything the president says at its face value. You have to assume it's a bargaining technique and that cooler heads will prevail and things will get back to normal. All right, so let's look at some more information here. Okay, so we have this an uptrend starting. Okay, so um, we also have from the COVID lows, we have um, support at where we went down during the initial tariff announcement right here. So we have a 20, no, 5-year support at this level right here. So even if we went down and retested these lows, sometimes that happens in a stock market whenever um, you have a very definitive crash panic situation. A lot of times you actually go back and do the whole thing again if there's another news story or something that brings us to that position. So you got to be ready for that. But if it does happen, we do have 5-year support of the S&P going back um, 5 years. We're overbought right now, but we're approaching this 200-day moving average. If we hit that and go over it, that is a bullish sign. That is really good for the stock market. And if we stay above that 200-day moving average, that is good too. Um, Another interesting thing that you got to keep in mind is the VIX. The VIX is really low right now. It's in its 20s. So it's actually 20 something, 2020. It went down 5% last week. When the VIX is low, the volatility is low also. So you have implied volatility of less than 1% a day. That means we're not going to be going through a crash situation when the VIX is 20 to 23. So that's a good sign that the stock market is stabilizing and we're kind of developing a new trading range, probably between here and here, here and here. All right. So we'll keep our eye on this fear gauge because the VIX that dictates how volatile things will be. Let's go back to our talking points here. Okay, this chart shows the 5-year support at the levels where it corrected to during the last correction. Let's look at let's look at the 10-year versus the S&P 500. The S&P 500 is actually going up as the 10-year yield is going up, which is um, there's a one-to-one correlation now, actually. Let's look at the review of the variables in the stock market. The price of oil is at $61 a barrel. That is still pretty low. So it doesn't, the oil market is one of the smartest markets in the world. So if it has a very low price of oil, it thinks the economies around the world will have will be slowing. So, and we have OPEC actually increasing output also, which decreases the price of the commodity. So, um, so it's up 5%. When it went up 5%, that's probably because there's hope that the United States and China will have a deal for tariffs in place. So if that happens, then the price will probably go up. All right, so all the other variables are pretty much the same. We have the price of gold up a little bit since last week, and the dollar is unchanged. But dollar is in a downtrend. So this is probably a very interesting chart. We all have money um, in US dollars. So we have to be very concerned that the US dollar is going down in value over time. So I guess ways to protect against this is to buy assets like stocks or real estate or buy gold because gold holds its value over time. Okay, so the fear and greed index, we're actually greed now. So translation is take some profits off the table or don't buy. All right, so we have, um, but we still have the AAII individual investor survey bearish. So this is like what, the 12th, 15th week in a row that the amateur investors are bearish. And the translation is it's time to buy or don't sell. All right, so we mentioned this before. The VIX is basically at where it was before the tariff correction. So when it's 20 to 25 or even 10 to 20, there's a very good indication that um, we're not going to see wild swings in the stock market on a day-to-day basis. And I guess that's good whenever we're trying to dollar cost into the market and have basically a steady environment. All right, so I changed from last week to this week. We changed from fear as our primary emotion in our emotion graph to greed. So we're actually in a process of, people fearing missing out, and they're buying, they're starting to buy stocks. All right, so okay, this is a chart to remind us that at the current rates, the PE ratio that people are willing to pay for the S&P 500 is much lower than where it is now. So if we look at okay, let's look at the worst of first. Hold on for 1 second. All right, the worst of first. Um, the worst performing sectors from last year were materials, consumer staples, energy, healthcare, and real estate. It seems like we do have that inverse correlation. The ones that are performing worst so far this year are communication services, technology, and consumer discretionary. That doesn't mean that over time that these stocks won't do well. QQQ, the IT sector has been on fire for the past 10 years. So, it has momentum. This is just an exercise to get you to think in contrary um, mindset. So, okay, what else do we have to say here? Okay. Okay, let's look at some of the stock market movers today. Okay, we have we have Boeing. They had some good news about orders from China. Um, Boeing is right in the middle of the crosshairs of this tariff situation. China canceled some orders to the company, and it's back and forth right now. Whether there's going to be tariffs, whether the Chinese are going to buy their airplanes or not. So that's all news based right now. Um, we have okay, we have a lot of these. Let's see, this is the Dow. Let's look at the S&P 500. We have some companies that had good earnings. This Insulet, I think they make devices for diabetes, insulin. We have the Tesla, which is one of the worst performing um, stocks this year, is starting to come back. It's up 5%. We have some oil companies, APA. We have ON Semiconductor. Okay, so we have a return to microchips right now. The semiconductor companies are in the top 10. We have the worst performing are Expedia. We have one problem with Expedia. Expedia is a company that allows you to buy travel, and it's an older technology company. So you can book a vacation there or rent a car. But the problem with Expedia is it could be disrupted by AI. So AI, you can talk to your AI agent and say, book, find me a good vacation under $200 that I can go to this weekend. And that will bypass Expedia. And there's an indication that a lot of younger people these days are moving towards interacting with chat GPT and a couple other AI agents and bypassing Google and search places like Expedia. Okay, so okay, I don't have any insight on the rest of these companies. All right, let's look at some of the sectors going up and down. Okay, so we know from, let's look at the 10-year. 10-year has been going down here. Okay. So, no, it's been going up in the last week. So as the interest rates for the 10-year go up since 428. Okay. So in the past week and a half, the rates have gone up substantially. So let's look at our cheat sheet. Yields for the 10-year going up. That's positive. Okay, that's positive for large cap tech stocks. They will, let's see, financial sectors. Let's see if these are the stocks going up today. For okay, let's look. Biotech is down the most. We have, as the interest rates go up, it's negative for speculative, non-profitable companies. Biotechs are speculative, non-profitable companies. Retail is down a lot. Healthcare is down a lot. Home construction. Okay. So as interest rates go up, it's harder to buy buy a house because of the rates on the mortgage. So that makes sense why that would be going down. We have regional banking. Okay, let's look at the ones going up the most. Gold miners. Okay, so gold and gold miners. We'll go over gold a little bit later. There's a push around the world for diversification against the US dollar. So anytime that the gold goes down, it could be a time to start getting in because the value of our dollar is going down. So over time, and it seems like that trend isn't stopping. Um, so in 10 years, when the price of a banana is like $10 a piece, we might want to have some gold that actually retains its value rather than having a dollar that's worth half of what it's worth now. That's an example. So let's look at other things that are going up the most. Telecom. Um, so let's look at what, okay, it's negative for high. So when interest rates in the 10-year go up, that's negative for high yielding things, but they're actually going up today. Um, Energy is going up today and real estate index. Okay. Well, that was a good exercise. Let's go back to our our talking points. Let's look at Dan Now's picks from the beginning of the year. Cash. That seems to be pretty good right now. I bet he's deploying his cash right now. ADTN, this is a play on AI. It's down 7%. Cisco is down 1%. And IJJ is this is the mid cap ETF. It's down 6%. And the banking ETF is down 3%. So cash is probably the best pick so far for his suggestions. And okay, this is just a reminder, some of the 10 worst day percent gains. 1 day decline. We had a situation recently where we had 15% in a short amount of time. And the return after 1 year is usually over 20%. Return after 3 years is positive, probably 11%. And return after 5 years is over 13%. So that's just a reminder that it's time in the market, not timing the market. Let's look at the some charts that I picked out as very interesting. You can see that gold is in an uptrend. It's one of the best performing sectors and investments this year. If we look at its trend lines, you can see it's at the bottom end of its trend line. If it continues this zigzag pattern up, we're going to have central banks buying gold to diversify against the dollar. So whenever you see the price of gold going up, it's the majority public it is a lot of people in the world trying to diversify against the US dollar. And so a lot of big countries are selling the US dollar and buying gold instead. And Russia is actually doing that also. They're not investing in US securities because they don't want to confiscate it again. So they're buying a lot of gold. And China is actually buying a lot of gold too. So anytime you have um, the price of gold going down, like it has recently, you have the central banks around the world buying gold. So let's look at some other stocks. We have Nvidia is in a noticeable downtrend. It's at the top end of its downtrend range. We have earnings coming out. So if you see, we're kind of in like a pattern here that goes back a couple years. The low end of this is around $100 a share, and the high end is where it's at right now, which is 116. If we have good earnings that come out at the end of this month, we have a little uptrend starting here, so it could start going back up again. But this is one of the stocks that are held in a lot of mutual funds. So it's a good idea to keep this on your watch list. Okay, and Eli Lilly, they're down based on they had forward projections at the last earnings call that were not as expected, and you can see it's in a trading range going back at least a year. So it's at the very low end of its trading range, and it's totally oversold, washed out. So usually this is a time to buy. Um, so we'll see what happens to this stock. And if there is announcements about tariffs on um, pharmaceuticals or the government not paying for drugs on a massive scale for Medicaid, then of course you have some problems, and and we can't do anything about that. So we'll see what happens there. And let's look at T-Mobile. T-Mobile is actually one of the only stocks that we're following that's in a multi-year uptrend. You can see it's at the low end of its range. And you can see it's a little bit oversold still, overbought. So those are some good things. We have to keep in mind our rare Zweig breadth thrust happened about 3 weeks ago. And so far it's turning out pretty good. Um, and this is 1 week later after this thrust happens, 3 weeks later, 1 month later, and 1 year later, it's usually 100% up from where it was before. We always like to look at the top holdings of the big mutual funds and see if there's any of these on sale right now. Because let's look at Rats. Okay. Okay. We'll get to it later on. Okay. So let's look at some stocks. Okay. NVIDIA is down this year. We have Amazon is down. We have Meta. It's struggling. Alphabet is down the most. Um, Eli Lilly is down. So we have a lot of our um, top 10 of mutual funds that are superior that are still owning the stocks that are down a lot. So if you don't own, if you're a growth investor and you don't own some of these, you could, as they are down 10, 20, or 30%, you might want to start dollar costing into them if you want to start a position. And this is a very volatile environment, so you might have to start with a very small amounts in your dollar costing to start getting into some of these. But these mutual funds don't sell a good portion of the top 10 holdings. So let's look at some more of the ones that are down this year. We see Apple is down a lot this year. You can see we have some good indications from um, this China, United States talks that it could yield positive news for the stock market. So we'll have to wait to see what happens in those China-US talks. But that could really help Apple and some of the companies that are hit by tariffs. We can see that JP Morgan, MasterCard are in are in the top 10 of Fidelity Magellan. And we also have Netflix. So a lot of these stocks are thriving in good environments and bad environments. So if any of them are down right now, it's a good time to start looking at them. Um, Berkshire Hathaway. Let's look at that stock right now. This is the second biggest holding in Contrafund. And let's look at Berkshire Hathaway, BRA. It's actually, let's look at the stochastics on Berkshire Hathaway. Right. Okay, we couldn't get it. Okay, this is an example of a stock that's it sold off whenever Warren Buffett said he would retire this year. And we have a rats. Okay, so the stock sold off when Warren Buffett announced he was leaving, and it went basically down to its lower end of its trading range. So if you see, this is one of the stocks that are doing really good this year. And let's look at continuously. Yeah, I want to show you how I draw my trend lines. Okay, so we have a trend line. Okay, so they're approaching the bottom end of their range. They're oversold, and yet this is the second largest position in the contra fund. So if you don't own Berkshire Hathaway um, and you're a growth investor, this could be one to start dollar costing into. Okay, so let's go back to our talking points. All right, and let's looking at stocks that are at the bottom end of their trading range. We have Google it's sold off a lot. We have Eli Lilly, they're down at the bottom of their range. And we have Berkshire Hathaway. All right, so let's go back to our notes. Okay, so I did a screen again. I included it in this talk. I picked out two stocks to go over. We have Google, which according to Fidelity, it's down, its PEG ratio is 0.98. So that means it's 8% undervalued. Goldman Sachs, it says it's 37% undervalued, which is the PEG ratio of 0.63. I thought it'd be interesting to go over both of those. Goldman Sachs, you can see that there is a uptrend in place for at least a year. And we're at the bottom end of our trading range, which is, this is the high end and this is the low end. And it seems like this sell-off was just a blip in the long, big picture. So we have a couple things going in the way of Goldman Sachs. We have deregulation. We're going to have more activity with new companies going IPO. And the financial sector is on fire. So if you put all those together, it seems like a good theme for this year. Financials have been have a little momentum going. Let's look at the stochastics for the just the sector in general. And financial sector. You can see that the sectors chart mirrors the Goldman Sachs, the pattern. It's in an uptrend and it has a very, very similar pattern here. So if we look at their numbers, their forward PE is 12. According to Yahoo Finance, their PEG ratio is 6, which is 6 times overvalued. I don't think that's right. Their profit margin is 28, and their return on equity is 12, which is both acceptable. The interesting thing is they have $300 billion in cash when you net the cash versus the debt. So you have 300 billion in cash. So they're so they don't need to borrow money. Usually banks borrow money, a lot of money in order to do their business. Let's look at some more information here. Okay, let's look at their growth rates. Okay, the yearly numbers from the average estimates going forward. We have 22% from last year to this year. We have 12% from this year to next year, and then 9% from next year to the year after. So they're growing about 12%, and their PE is 12. So that means they're fairly valued. It's not that exciting of a proposition right now. If they sold off, then you would have a discount or some kind of margin of safety. But right now they're basically growing at 12%. P ratio is 12. It's not that compelling. Let's look at what Morningstar said. Morningstar says they're fairly strong end to the year. We expect continued strength. They think they're overvalued by 22%. So, so Morningstar thinks they're overvalued by 22%. Then, and we think it's kind of fairly valued. Let's look at what CFRA said. They have a strong buy in Goldman Sachs, and they said they should be a direct beneficiary of a recovery in investment banking in the second half of 2025. If the interest rates, go contrary and all the banks go down because of interest rates, you have to remember that only 19% of their revenue is from interest-related expenses. So I guess they make a lot of money doing helping companies IPO, etc. And their trading, they have a trading unit too. So the more volatility there is, the more money they make in trading. So the fair value is 513. That's 9% overvalued. So although our screener said it was undervalued, had a peg ratio of 0.8, it looks like it's actually overvalued. Um, so it's not that compelling of a buy for me right now. All right, another stock in our screen, we have Alphabet. You can see in our Fidelity output, Fidelity thinks it's undervalued by 8% because the peg ratio is 0.92. So we're going to check it on Alphabet to see if the numbers match our expectations. Okay. Okay, so let's see what Morningstar says about Alphabet. They think that Alphabet is on sale, 13% off. One of the reasons why um, Google sold off this recent week is Apple. One of the executives at Apple said that Google is not increasing their clicks anymore for advertising. A lot of their eyes are going on this chat GPT or AI um, to get their answers. So it's called a canary in the coal mine. Whenever you have one piece of evidence that Google could be losing their money printing machine, you have to take it seriously. So it seems like that a good portion of the younger population are interfacing with ChatGPT and a lot of AI chatbots to get their answers, to get their questions answered and do their queries. So less people are clicking on ads for Google, according to Apple. Apple also said this week that they're going to be using AI in their searches for Safari instead of Google. So that could totally hurt Alphabet's prospects. And so let's look at what Morningstar says. They basically said it's on sale by 13%. And they think that the fair value is going up, but still they think that they're undervalued by 13%. Um, let's look at what CFRA said. They said our buy reflects attractive valuation, free cash flow potential, and sustainable 8 to 10% revenue growth through 2026. Cloud is growing 14 to 17%. Um, so I think let's look at the yeah, let's look at what they said. So CFRA says that Alphabet's a buy, and their fair value is they're on sale by 13%. So that matches the Morningstar 13% off. This is one of the greatest parts of the report here is that the earnings are continuing to grow around 11%, and they're projected to grow like 11%. Um, let's look at our watch list from the beginning of the year. You can see Novo Nordisk is down the most. We have Tesla down 21%, even after today's 5% up move. Google is down 19%. Apple is down 19%. NVIDIA is down. I highlighted the ones that are down a lot that are also in some of the mutual funds we admire. So it's good to if you're interested in having a set it and forget it portfolio similar to the mutual funds, it's a good time to buy some of those whenever they're down. All right. So, okay, here's a something to keep in back of your mind. We have a, a potential crisis in the US dollar in the treasuries. We have we have countries that are moving away from investing in US treasuries. So we have China that they're reducing their buying of US treasuries. We have Japan, they're threatening to sell their treasuries. Um, we had Russia have their US investments confiscated through sanctions. So, if China's thinking about taking over Taiwan, they're not going to put money in the United States so it can be confiscated. So, so it looks like we have a problem that could happen eventually that there's an interest rate for the 10-year or 20-year or 30-year going up. And that could hurt our potentials of paying back um, our debt. So that's a eventually this is a guy that in this report, former International Monetary Fund chief economist. Wow, that's very good. Um, he's really afraid of a potential problem with the US dollar. And we also have um, a debt increase that's coming up. If we don't increase our ceiling for debt, we'll default on our debt. So that always resolves itself through at the last second. But this is something to keep in mind. There could be a next thing to worry about, but it's not imminent. Okay, here's some two stories that I found. Um, we had this trade talks happening this weekend, and the stock market was basically waiting on Friday. It was like closed, little changed, waiting for this trade talks. And if something good comes out of it, then the stock market will most likely go up. Um, let's look at we just talked about this. AI's upended the search game. Marketers are scrambling to catch up. So websites used to be the primary data source for AI platforms. Um, well, I messed that up. Websites used to be a place where people go for their information. Now they're being used by AI platforms to tell people their answers. So this is a huge change in investing. Um, we have to really keep in mind that over time, it seems less people are going to be clicking on ads on the internet, and more people are going to be doing searches with AI. So as an investor, you have to like position your portfolio for both situations because we don't know which one will work. I mean, will be the winner here, but it seems like AI has momentum. So if we look at our stocks that are, um, let's look back here. Let's look at some of the stocks that would benefit from AI taking over as search in the world. The biggest winner is NVIDIA. We see NVIDIA as a top holding in most of these mutual funds. There it is right there. We have NVIDIA right here, top two. Wow. So, and it's down this year, down like over 20%. There's other winners from the AI infrastructure and build out. Microsoft, they have um, they have AI offerings. We have, look at this, Microsoft is the top holding of this fund. Um, Microsoft, another top holding of this fund. Okay, so we have Meta is also one that would benefit um, because they use AI in a major way to recommend products to advertising for each of their people on their platform. Um, okay, okay, let's look at All right, that is what I wanted to say about that. Okay, let's look at Google. You can see it's at a defined downtrend, um, but you can see also that we've had this low. We're like in a trading range, sideways trading range for at least a year. And we're at the absolute bottom of that trading range right now. We're totally oversold. There are people that are basically saying right now, don't count Google out. They have an AI offering and they have how many million? They have over a billion daily active users. So it seems like they're going to be in a trading range, going for the next until this AI situation is resolved. They have it, Google also has some litigation. They might be broken up. So you just have to worry about that also. So that's another reason why they're down. Um, Google also had a problem where they had a privacy lawsuit in Texas against Texas that they lost. $1.4 billion lawsuit. So we have a combination of problems for Google that are keeping it at the lower end of its trading range. So anyways, this is an interesting um, time to look at this stuff. And okay, just the last reminder here that um, it takes a little bit of pain, when the stock market goes down a little bit, but most of the money is made during the bull markets. So we're kind of on the edge right now of um, we're down 5% this year in the S&P. So we're kind of on the edge of being in a bull market or bear market. So we'll see what happens. If we look at our S&P, we are a bit overvalued in the S&P right now. We could be in a trading range right now between 4,800 and 5,600 where we're at right now. So we could be going back and forth between that for a while. But if we break above this 200-day moving average and we stay above it, that is a really good sign that we're baselining and for potential resumption of our um, uptrend. So we'll see what happens. Hope you have a really good investing week. I'll talk to you all next time.